Hello everybody, my name's True Demon and I'm the Devil's Stockbroker. Today in this video, I want to cover something that I feel is talked about frequently but not necessarily well understood, and that is the idea of reverse repurchase agreements. This is a tool that's used by the federal banking system to provide cash reserves to the federal bank, and it's provided by the smaller district banks or the individual private banks that exist throughout our system. You think of Bank of America, JP Morgan Chase, Goldman Sachs, and so on. Reverse repurchase agreements allow the Fed to hold on to a significant amount of capital that they can consolidate from all of these banks in order to absorb operating costs and for them to continue making banking operations for the Federal Reserve, uh, especially during times of trials and tribulations like we went through with COVID and since then. However, what has been going on in the reverse repurchase agreement market shows that this system is working in an unusual way that we have never seen historically before. And there is a good chance that there is fraud taking place. And that is what we are going to examine and uncover. I want to start this video by thanking a member of the Hell's Trading Floor Discord, Tempestuous Persephone, who did a very, very thorough deep dive into reverse repurchase agreements and brought all of this together for me so that I would be able to bring it to you. So thanks to her for doing all of this research. And with that, we'll get straight into it. So here we have the Fed and all of the district banks. So the way that a reverse repurchase agreement works with this very simple diagram is you have the small district banks which have some cash. They're flush with cash. They got some cash to work with. They don't need it right now. The Fed needs cash. So, in order for the Fed to get this cash, they need to incentivize the banks in order to deposit the cash at the Fed. So, the Fed says, "Hey, smaller banks, we need some cash. How about we offer you a deposit, a repurchase agreement, a reverse repurchase agreement to give us your cash. And tomorrow morning, we will deposit that money back to you with interest." And the bank says, okay. So they send a very large sum of money in the tune of millions or billions of dollars to the Fed. The Fed piles up all of this cash. And then the morning after, all of this money gets distributed back out to all of the individual banks with a tiny sum of interest. And that goes all the way back to all the different district banks on an individual basis. You could think of this as a way for the banks to collect compounding interest as well. Because what we've noticed is that these small banks, they do these reverse repurchase agreements nightly. They are overnight reverse repurchase agreements. So the Fed is only holding this money for a 24-hour period at most, at which point it returns the money to the bank. Now, the Fed can renew the reverse repurchase agreement, but the bank has to redeposit the money. And this is often referred to as the money market system, which allows the smaller banks to give their customers profit off of individual deposits for cash that are just sitting in the system. It's a lot of complexity, but under the hood, this is all very simple. The bank gives the Fed a sum of money. The Fed gives them back the full amount plus a tiny, tiny amount of interest. And this has allowed us to use our banking system and consolidate it into a single institution which is able to respond to crises, such as what we went through during COVID. So, starting in March of 2020, which you see is this little blip here, this is the reverse repurchase agreement sum total of cash that has been put in reserve at the Fed on each given night. In March of 2020, this is exactly when COVID hit us, which you can see by the SPX market took an absolute total dump on everybody. In response to this, the Fed had to come up with some way of offsetting the costs of operations and to stimulate the economy. Because what was happening was everybody was shutting their doors, businesses were closing, the economy was shutting down, and nobody was going outside. In the wake of this, the Fed realized that we were at a crisis time and they needed to get people money. This was done very urgently and hastily in order to save people from sudden fears of bankruptcy, not being able to afford food, water, and essentials, and just there was just general panic everywhere. And when this happened, the Fed immediately started putting to work all of this money within the banking system through reverse repurchase agreements. They consolidated all of this money into the Fed, and then they started using the money through their operations in order to push money out into the market, and they gave the banks back all of their funds through interest. Interest, which was, by the way, printed, freshly printed money. And most of these transactions, by the way, happen digitally every single night. This is not an actual physical transaction of cash, it is a digital one. So the Fed and the banks they transact this cash through a computer system for the most part, and then the Fed returns a balance that is just numbers on a screen. And that's the number that the bank has. So printing money for the Fed is extremely simple, and it's done through this system I believe intentionally to make the system work more efficiently, but it introduces some level of risk because I detect the opportunity for fraud. Going further on, as we look further, the entire market, the entire market has been absolutely ripping, just absolutely ripping for such a long time, especially after the reverse repurchase market started to get crazy. After March of 2021, at a time when we were going back into lockdown and we weren't sure that whether COVID was here to stay, the reverse repurchase agreements overnight deposits started to skyrocket and stayed high every single night. And it kept growing and growing and growing and growing and growing and growing and growing all the way up through the peak of the SPY. And then suddenly things started to turn around for the market, but this has continued. And I want to know why. Further to this point, if we look at the US year over year inflation rate, we notice that inflation at this time, just before COVID hit us in January, inflation was at a modest 2.5%, which is, that's relatively reasonable. That's pretty close to the Fed's target, keeping it below 2% ideally, but 2.5% is not bad. And as long as inflation is not out of control and employment is good, the Fed doesn't really have to do much of anything. However, when COVID hit us, you'll notice that they needed to suddenly address a massive unemployment issue, and hence why they stimulated the economy, which you can see with this. You will no doubt notice that unemployment kind of had a little bit of a blip in its trend. But after March of 2021, both unemployment and inflation started to invert each other while the reverse repurchase market continued to surge repeatedly. This seems to me like a problem, and it kind of boggles the mind as to why the Fed didn't respond in any way, and to date still hasn't responded to this issue of reverse repurchase agreements surging nonstop and continuously maintaining their highs. Because let's not forget, these deposits are nightly. That means that every single time this number grows, it's because the bank added more money to the cash reserve system. So they have to add this money back into the reserves every single night. This is done intentionally so. So why is it still growing? Well, that's what we're going to unpack. I'm brought to the Mises Institute article, which is titled, "Who Owns Federal Reserve Losses and How Will They Impact Monetary Policy?" This is a excellent article, which I feel really well summarizes the issues here. And first, what reverse repurchase agreements are used for, but more importantly, why we have a problem in the Federal Reserve System. So I'll ask you to bear with me while I go through this article with you, and we're going to find out how this relates, what this article is talking about, back to reverse repurchase agreements. So the article begins. Among Federal Reserve officials and many economists, it's fashionable to argue that any losses the Federal Reserve should suffer, no matter how large, will have no operational consequence. Is this true? If so, how does the Fed account for its losses and stay solvent? And who ends up paying for these losses? As the Fed executes its strategy to rein in runaway inflation, the answers to these questions take center stage as the Fed has already experienced mark to market losses of epic proportions and will soon post large operating losses, something that it has never faced in its 108-year history. We estimate that between December 31st, 2021 and the end of May 31st, 2022, the Federal Reserve lost $540 billion in market value on its huge portfolio of investments in treasury bonds and mortgage-backed securities. To put this loss in perspective, $540 billion is equivalent to 60% of the value of the Federal Reserve System's entire asset holdings on September 1st, 2008, just prior to the onset of the financial crisis. $540 billion is more than 13 times the Federal Reserve's recently reported consolidated capital of $41 billion, meaning that the market value of the Fed's outstanding liabilities, primarily member bank reserves and Federal Reserve notes, exceeds the market value of the assets the Fed owns by about $500 billion. As interest rates go higher, this loss increases. Remember that to fight inflation, the Fed has to raise the interest rates. The federal funds rate must go up. This causes interest to rise, and this causes the Fed's operating costs to rise. Moreover, if the Fed's inflation fighting campaign eventually requires short-term interest rates to rise above 2.7%, we project that the Federal Reserve will experience net operating losses in addition to its mark-to-market losses. The interest rates are already well above that. They're well over 5.5%. Some are being estimated of over 6%. Unlike banks and other financial institutions, no matter how big the losses it may face and how negative its true capital position, the Federal Reserve will not fail. But if losses, however large, can't end the Fed, who pays for these losses? Will the Fed's shareholders be hit in some fashion, or will the losses be monetized and contribute to spiraling inflation? Should member banks be paid interest when the interest payments cause Federal Reserve losses? In recent years, questions like these have been irrelevant because the Fed has made very large profits, but this year is different. Federal Reserve officials try to downplay the gravity of these issues. For example, at the recent Federal Reserve Bank of Atlanta Financial Markets Conference, Federal Reserve Bank of Cleveland President Loretta Mester said that losses would have no impact on the Fed's ability to conduct monetary policy, but admitted they could raise, quote, communication challenges for the system. This rather cavalier treatment of the massive Federal Reserve losses is curious because it is potentially at odds with the way that Federal Reserve losses should be treated according to the Federal Reserve Act. Moreover, given the large interest that income banks earn on their reserve balances, the issue of burden sharing of Federal Reserve System losses may become much more contentious as the Fed executes its inflation fighting policies in the coming months. Now, this statement right here was extremely, this one glowed on the screen for me. What this is saying is that the large interest income banks earn money on their reserve balances. This is something that we know about, but it also brings up the topic of burden sharing, meaning that when the Federal Reserve starts to lose money, the question becomes, do the banks that have been cashing in from the Fed by receiving these interest payments and these incentives for depositing their cash to the Federal Reserve, do they need to pay something back too? Should they be forced to share the cost? The real story of how the Fed accounts for losses, how the losses impact monetary policy, and who ultimately pays for these losses is a complicated one. The details are in some little-known provisions of the Federal Reserve Act of 1913. In more recent Federal Reserve Board policy decisions regarding the Fed's accounting standards, in legislation changing its dividend and capital surplus policies, and in its post-financial crisis decision to pay interest on bank reserve accounts. So, this is not a well understood or even well documented process. And now we're going to get into who is actually going to bear the cost when this inflation situation gets out of hand, because it is already getting out of hand. The Federal Reserve Act stipulates that Federal Reserve shareholders, the member banks, should bear at least some Federal Reserve System losses, but to date this has never happened. Innovations in accounting policies adopted by the Fed Reserve Board in 2011 suggest that the board intends to ignore the law and monetize Federal Reserve losses, thereby transmitting them indirectly through inflation to anyone holding Federal Reserve notes, dollar-denominated cash balances, and fixed-rate assets. This is the statement. This is the smoking gun. If the losses are monetized, it means that the Fed is going to take these operational losses and print more money. And printing more money will create more inflation. And it passes off the operating costs of the Fed off to the taxpayer directly. It does go directly to the taxpayer because it devalues the dollar in such a way that reduces the buying power of your cash at the cash register. And it also directly affects the value of bonds and treasury notes, which are fixed income assets. They have a maturity, meaning that after a certain date, you get payments, but you have to wait until those maturity dates. And that is a fixed asset. You get a fixed rate of return. And the problem with that is that inflation, if it outpaces the return of the bond, then you take a loss because by the time you receive the cash yield from the bond, you've already lost buying power in the same way that we lose buying power when inflation attacks the value of our dollars that we have in our savings bank account. And let's go and take this a little bit further and go back up to what was stated earlier regarding the Federal Reserve's asset holdings. It specifically mentions treasury bonds and mortgage-backed securities. I would like to point out to you that since December of last year, the value of VMBS, which is the Vanguard Mortgage-Backed Securities ETF index, has tanked massively by 13% almost. It's slightly recovered with this latest bounce that we've had in the market, but overall, the mortgage-backed securities industry has been falling ever since May of 2020. It has not recovered. And that's telling because right now, understand, mortgage-backed securities are generated by the creation and origination of new mortgages, which are created by people buying homes. And right now we're having a housing surge that's going to lead us to a housing crash inevitably, at least in my opinion. But why are mortgage-backed securities dying in value? Why are they deflating in value when the amount of new mortgages are just going absolutely bananas? It doesn't make sense. Well, think of it this way. We've had more cash buyers, which means that people are getting out of their mortgages. And if you get out of a mortgage early, then that devalues the mortgage-backed security that it is attached to, because the recipient of that MBS gets fewer returns at the end of the year. And the more people that pay off their mortgages, eventually the mortgage-backed security is actually, it's fully paid out and there are no more returns. So it's fully matured. So whatever the person bought it for may actually take a loss because they were expecting those returns. There's other parts of this that play into the market more broadly, but the point here is that mortgage-backed securities are bleeding in value, and it's signaling that the Fed and other banks are losing their asses on fixed-rate assets like mortgage-backed securities, and they're quickly abandoning them. And this ETF reflects that sentiment. Here's another one, which is MBB, the iShares mortgage-backed securities ETF created by BlackRock, which got started in April of 2007 or March 2007 and recovered after the mortgage-backed securities cratered in value, and we saw new highs from them since then. But after the fiscal crisis, during the fiscal crisis, these hit an all-time low, and we have surpassed that low. The value of this ETF is far below the value that we had we had hit the low of during the 2007 subprime crisis and the subsequent crash that happened in 2008 in September. So, you want to tell me that mortgages are fine, housing is fine, and mortgage-backed securities are fine, the Fed's fine, inflation is fine, and that's only transitory. Like, there's so many things wrong with this picture. I don't even know where to start, but I'm going to try to get back to this article and we're going to figure it out. So the article goes on. In the Federal Reserve System's most recent financial statements for the quarter ending March 31st, 2022, the fair value note to the statements show a total unrealized capital loss of $458 billion during the quarter on the Fed's $8.8 trillion book value of the Fed system open market account. Think of this as their portfolio. The Fed's stock portfolio took an unrealized $458 billion loss during the March 31st quarter of this year. That's massive. They've got $8.8 trillion in book value that they're going to be dumping on the market here, and it's already lost $450 billion. That's insane. And all of these assets that are going to be just shoved down the throats of investors in the stock market are going to feel the pain because they're going to sell no matter how low the price gets. If there's no demand for these assets, and there already isn't, it's going to cause massive crashes throughout the rest of the stock market that we're going to feel instantaneously. And the banks know this. So the banks are looking for any way that they can possibly squeeze any money out of this system as risk-free as possible because that's their job. But also, they're going to look for some way of getting the money out of this market because right now the US economy is absolutely at its weakest that it has ever been since the Great Depression. I'm absolutely convinced that at this time we are in the throes of what may be a total financial meltdown of our entire stock market and economic system, coupled with the total hyperinflation of the U.S. dollar that will lead to it being lost as the Federal Reserve or as the world reserve currency. It's a really scary thing to think about because that's Armageddon for the US economy, but it's also going to be like the worst day ever for the entire world's economy because the US dollar is the backbone for the world economy being the world reserve currency. So the article goes on to say that the interest rates continuing to increase, we estimate that the Fed's unrealized capital loss grew by an additional 210 billion. This just isn't that great. So that brings the Fed's total unrecognized capital loss to an estimated 540 billion as of May 31st, 2022. The losses continue to grow through mid-June, and should the Fed maintain its plan to continue raising interest rates to fight inflation, these losses will only increase. If the Fed was a bank or other regulated financial institution, it would be closed because it is already deeply economically insolvent. So I don't think that I need to break this down for anybody, but just for the sake of putting it in simple terms, right now the Fed is hemorrhaging money at such a rapid rate that any other bank, if JP Morgan Chase or if Bank of America or Goldman Sachs, any of them posted these kinds of losses, that bank would be shut down today. It would have been shut down yesterday. So in addition to the deleterious impact of rising interest rates on the market value of the SOMA portfolio, rising interest rates will sharply reduce the Fed's net interest income. In the first quarter of 2022, the Fed reported net interest earnings of 35 billion, which when netted against expenses yielded a reported total operating income of 32 billion, a figure that excludes the mark-to-market losses on its securities portfolio. So it's essentially breaking down to the Fed is if you do not count their total losses, they're barely holding their head above water while printing money at a massive rapid rate that they have never done in the past. And this is where the reverse repurchase agreements start to come into this, and this is where the truly scary shit begins. So as interest rates continue to increase, the Fed net interest revenue and operating income will decline as the Fed pays higher interest rates on $3.3 trillion in member bank reserve balances and its nearly $2.3 trillion as of June 1st in reverse repurchase agreements. While it earns interest on largely fixed rate securities, its SOMA portfolio. According to our estimates, if short term interest rates were to reach 2.7%, the Fed's net interest income would no longer be sufficient to cover its approximately $9 billion in annual operating costs, and the Fed would post an annual operating loss. This fact is especially relevant given that the FOMC forecast has the federal funds rate at 3.4% by year end 2022. So this is already a bad enough situation because as the bank's member reserve balances increases and the interest rates that the Fed raises continue to increase, the Fed's going to continuously be posting operating losses. And it's eventually going to hit a point where it's net negative and then the operating losses will exceed their operating revenue. If that happens, then the Fed is upside down and they're considered totally insolvent, but they're already in that state right now. The only reason why they're holding their head above water is because they're printing money at a ridiculous rate. So, with annual inflation currently running at 8.6%, that's a figure as of April, 3.4% may not be as high enough short-term interest rate to tame inflationary pressures. Since this article was written, this has been driven up massively to nearly 6%. So the federal funds futures and several bank economists project that policy rates will need to rise to 4%, again, already higher, and we're not even into 2023 yet. We're not even halfway through the year. Ignoring mark-to-market losses on its SOMA portfolio and absent any realized losses from SOMA asset sales, we project that the Fed will post an annual operating loss of $62 billion if short-term rates rise to 4%. Again, already past it. A $62 billion loss is 150% of the Federal Reserve's system's current capital. This is all bad enough. This all is a really terrible situation for the Fed and the US economy, but this is really only just to illustrate to you the situation that we are in economically speaking and the position that the Fed has put us in, because it was their decisions and their monetary policy and their decision to ignore inflation that brought us here. They didn't address it in March of 2021 when they should have seen it. And instead, the reverse repurchase agreement started to skyrocket. And that has a very detrimental effect on inflation that we're going to address right now. Because the reverse repurchase agreements, that's a voluntary action by the member banks. And what I suspect is that the member banks are abusing this system to create risk free capital for themselves. They are using it at the expense of the Federal Reserve and, by extension, indirectly, the taxpayer because of generating inflation and also forcing additional operating losses on the Federal Reserve Bank. And in the meanwhile, the member banks are profiting. They're laughing all the way, and what they are doing is they are taking this money elsewhere, and it's going to have a absolutely detrimental nuclear destructive effect on the United States dollar. So I'm going to skip ahead just a little bit into this article that we get into the relationship between reverse repo and the member banks, because this is the part that matters, and this is where we get into the, I guess, a conspiracy that the member banks are purposefully and intentionally deflating the dollar in order to get more of it so that they can push it out to other markets. Okay, so member banks earn dividends on the Federal Reserve District Bank stock holdings and the Federal Reserve System dividend policy, which impacts the Fed's capital surplus account. That's reverse repo and also their cash reserve, which, according to the GAO, is, quote, intended to cushion against the possibility that total Reserve Bank capital would be depleted by losses incurred through Federal Reserve operations. So this this is only meant to be used as a way of propping up the Federal Reserve during emergencies, but it's not being used that way because the Federal Reserve shouldn't be needing this much capital right now. What they should be using is what they should be doing is selling assets, and they should have been doing it a year ago. But there's something wrong here. Now, in return for providing the district bank's capital base, all member banks were initially entitled to receive a generous 6% dividend on the par value of their paid in shares. This is important. The dividend was cumulative in the event that a district bank had insufficient operating revenues to cover expenses and dividends in any given year. Essentially, member banks purchase shares of the Federal Reserve Bank and then they get dividends out the same way that we get dividends on stock. But just like everything else, that requires them to, they have to purchase the shares for one, they have to buy it, and they have to hold it in order to receive those dividends. And that was how the system worked in the past. But ever since 2016, it's no longer the case. So, more recently, the dividend rate was reduced for large banks, currently defined to be banks with assets in excess of $11.2 billion. This is because most banks hold on to trillions of dollars. They have massive assets. And because of these massive asset portfolios, 6% dividend on that much money would be absolutely crazy. The dollar would be deflated to hell so rapidly. It's an insane amount of money. So just to make sure that we did the math, I went and calculated it, and 6% of $1 trillion, if a bank had deposited that and received a single dividend from it, a single dividend on $1 trillion deposit of purchased shares would pay out at $60 million. Now, the key here is that buying the buying the Federal Reserve shares, they have to hold on to those shares for a certain period of time to receive the dividend. That's how the system works. But if it's not being used that way and it doesn't exist this way anymore, and as well, this interest rate of 6% is no longer the case. This is how it works now. So now, the annual dividend rate for these banks is the lesser of the high yield of the 10-year Treasury note auctioned at the last auction held prior to the payment of such dividend, or 6%. So it's a lot of gobbledygook to say that it's basically the banks are capped at an absolute maximum of a 6% dividend, or the yield of the 10-year Treasury notes. That's bonds, 10-year bonds. Now, the 10-year Treasury bond, as we'll look here, is actually way lower than that, and it's been that way for quite a while. As you can see that from this chart, this is the US 10-year bond. The bonds haven't been 6% since the dot-com bubble. The bonds have not been worth that much for a very long time because honestly, they shouldn't be. The amount of money that is generated by our system, because we have so much money in our system, if it was above 6%, it would result in just it would, as I said, it would result in a massive inflation of our dollar because it's creating money out of thin air. Now, the banks, however, they realize that they receive whatever the bond's yield is capped. Okay. The max that this thing can ever be is 6%. But if the bonds go to a super ridiculous value, no matter what, 6% is the highest that they can absolutely go to. Now, when we hit just after we had hit the COVID crash, the bonds had dropped to a ridiculous like 0.6% yield is the lowest that it's ever been. And ever since then, the bonds have gone up. And that's interesting, but they especially started to get ridiculous after the reverse repurchase agreement started to go up. Now, why am I talking about bonds all of a sudden when we were talking about reverse repurchase agreements? Remember what I said, that reverse repurchase agreements, they receive an interest payment. Every time a bank deposits this cash overnight, they get an annualized payment that is paid out for the day. So it's an interest payment. You would normally compound for yearly interest. You divide that amount by 365, you get that's a daily interest payment. So that interest payment directly relates to these 10-year bonds because the lower this value is, the less the banks get paid. But we noticed that after March of 2021, all of a sudden reverse repurchase agreements started to get ridiculous. And you'll notice that the bonds were going up at the same time. The bonds went from 0.8% up to nearly 1.7%. And that all of a sudden triggered a lot of buying in the reverse repurchase agreements market. And suddenly the Fed was getting flush with cash. Now, who decides the price and the yields for these bonds? Well, the Fed does. And the thing is that this is dictated by supply and demand the same way as everything else in the market is. So let's think about this just for a second. During the COVID crash, bonds were worth basically nothing. The 10-year bonds were almost totally worthless. They were barely paying out anything. And for a long time, bonds have been like totally useless anyway. But also, this change was instituted only since January of 2017. So this is a new change. And the dividends for reverse repurchase agreements were, albeit they were very large, but it had only included dividends for shares in the Federal Reserve. Before 2017, you had to buy shares in the Federal Reserve to receive the dividend, and you were only receiving those dividends every so often, the same way as you receive a stock dividend. With the reverse repurchase agreements being added into this, you could get reverse repurchase agreement interest daily. And that computes that if you kept putting this money back into the system every single day, if you kept depositing the same amount every single day, you get daily compounding interest over and over and over again. And this is exactly what the banks are doing. They're depositing this money back into reverse repurchase agreements, back into the bank, which they only have to hold overnight. They get the cash immediately the next day, and then the bank gets to use that money however they want, and then they just deposit it back in before the close of business that day, and suddenly it's money making money, and it's risk free because the Federal Reserve can't fail. So understand that the smaller banks are using this system to generate liquidity. They build they built this system as a way of protecting the Federal Reserve from operating losses, but it's being abused. This system is now actually working against the Fed because the reverse repurchase agreements are being used by the member banks to increase their own liquidity. And let's also remember that it's specifically the 10-year bond that this affects. Now, how do you raise the value of a bond? What dictates that? The Fed does, right? Remember, I said that the Fed dictates what the value or the yield of the bond is. Well, that is controlled by supply and demand. So, really quickly, let's understand that there is a relationship between bond prices versus bond yields, okay? A bond's price is what you pay to buy the bond, okay? The yield is what the bond pays you in interest, okay? These are inversely related. The more demand there is for a bond, the higher its price is. But the higher its price is, the lower its yield is. The bond's yield goes down as the price rises, right? And this is in order to control supply and demand. Normally, this is controlled by the Fed, and the Fed, in order to raise demand, will increase the yield and thereby drop the price of the bonds. This creates a increasing interest relationship that makes the bond more attractive to banks and investors. This is what causes people to want to buy bonds because if the interest rates are high, then they get a safe return. But if the bond's yields are low and the price is high, it's not as attractive. It's going to cause people with less cash to be able to qualify to buy a bond, meaning they don't have the cash to actually purchase the damn thing. And also, the banks don't want to bother because they can make more money elsewhere. Now, what is this is where the key is, though. If nobody is buying the bonds, no matter how low the price gets, the yield has to go up. And now we see a conflict of interest. So now we're going to take a look at reverse repurchase agreements overlaid by the bonds. So here we're looking at in the light blue, we're seeing the yield curve of the US 10-year bonds. And we're seeing it up against reverse repurchase agreements in the dark blue and then inflation in orange. Now, what we see is that the value of the bonds absolutely cratered to basically nothing. It's like next to worthless. It's like 0.56%. That's almost no return. And then all of a sudden, when reverse repurchase agreements started being made, it happened right as the bonds started to bounce. And what I think this triggered was it triggered a connection for the individual member banks, the low the lowly investment banks that are members of the Federal Reserve District banks to notice a correlation between the 10-year bonds, and they started looking at this and realizing after making these deposits that they could be incentivized, that they could make better returns if they could lift the yield of the 10-year bond without having to actually buy the damn things. And if you notice, after we got out of the initial lockdown period and the banks started operating again in August, after all of the checks had arrived in US citizens' hands, suddenly the yield on the 10-year curve started to rise. And I suspect it's because the banks decided to stop buying them. If the banks refuse to buy these bonds, it causes their price to drop. And if the price drops aren't enough to attract more investors and buyers, then the next step is for the Fed to raise the yields. When they raise the yields, that increases the interest payments that these banks receive on reverse repurchase agreements. And what you will notice is that all of a sudden, as the bonds started to rise in their yields, at a certain point, reverse repurchase agreements, at a time when the bond yields were above 1.6%, that's when reverse repurchase agreements started to rise, and it rose fast. Conversely, the 10-year yield on the bonds started to drop really quickly, but reverse repurchase agreements kept going up. Now, remember, this is an annualized interest return that the banks are making on reverse repurchases nightly. It's daily compounding interest annualized at a rate of interest that's basically pinned to the yield of the bond every single day. So let's just go calculate it out. How you would calculate this, to do it for a single day, you would take whatever the value is of the initial deposit. So we take the reverse repurchase agreements here, and that would be $450 billion. Nice round number. 450 billion. You multiply that by the interest rate, which is currently sitting at 1.56. So 0.0156. Okay? This is the annual return. You divide this by 365, and $19,500 is how much the banks get back. That's an immediate nightly return. Okay? Now that's pretty modest. It's a small amount for like billions of dollars. But now where we currently are shows just how quickly the banks figured this shit out and how quickly they started fucking abusing it. Currently, I'm going to mark June 14th. That's just before last Friday, or the Friday before last, that the 10-year yield was at 3.475%, and there was more than 220 there was excuse me, I'm sorry, I'm just getting so damn mad. There's $2,223,8 billion in reverse repurchase agreements. So let's go ahead and bring that up in the calculator. 2,180,980,000,000, and that's the number that they are depositing nightly, multiplied by 0.03134. That's an annualized return of $68.35 billion. That's more than some of these banks manage in their total assets. So now we have to divide this number by 365, and then you get the daily return. This is the actual daily return. So on this $2 trillion, they're getting 187.3 rounded $1 million, $187 million every single day for this bullshit. And the more that this yield goes up on the bonds, the more they make. Now, this is being done on purpose. These reverse repurchase agreements is an infinite money glitch for the fucking member banks of the Federal Reserve, and they know it. That's why this is going up. They're getting fucking risk-free returns on this shit. And they're not buying the 10-year bonds purposefully to drive up their yield. And this is why the 10 and 2-year yield curve has been inverting. This is all part of it. As long as the banks continue to buy all of the other bonds and driving up demand for those bonds while refusing to buy the 10-year bonds, the 10-year bonds yield will continue to go up. And because of all of this, just the 10 and 2-year yield curve, that's the difference between the returns of the 2-year bonds versus 10-year bonds. Whenever it inverts, that means when 2-year bonds have better returns than the 10-year bonds. When that happens, that's a signal, a great big red warning flag of a recession coming for the entire economy. So if the banks are fucking with the bond prices by they're either denying or applying supply and demand for those particular bonds, it's affecting their prices. And they're doing it because the reverse repurchase market is a risk-free vehicle for them to continuously be making infinite fucking money. And if they deposit enough of their cash into this, they can just continuously generate unlimited returns. And the money is safe because it's sitting there parked at the Fed. This is the reason. This is the reason why reverse repurchase agreements are just going absolutely bananas and nobody understands why. Now I want to know is, does the Fed fucking know this? And if the Fed knows this, then what are they doing about it? Are they content to be sitting flush on this cash and paying out these interest payments? Are they complicit to this? And does Congress know about this? That's what I want to know. Congress has been sitting here going through like all kinds of shit over the GameStop situation with, the giant squeeze that happened in January 2021. They're dealing with the war in Ukraine. They're dealing with the Supreme Court running away with all kinds of different federal cases and overturning Roe v. Wade and all kinds of ridiculous shit. All of this is happening at the same time. There's so much shit happening geopolitically right now. It's a miracle that anyone can even pay attention to it all. It's no wonder that nobody wants to even look at the news anymore. We all want to shove our head in the sand. And this is all happening under the fucking hood. Nobody's talking about this. I know nobody's talking about this. There's no way that anybody noticed. I want to especially thank, again, Tempestuous Persephone for figuring this out. It was her observations and deep dive into this market that figured this out. And I secondarily want to thank Scrap Queen for turning up all of these articles that led us down this rabbit hole. This has been oh my God, it's so eye-opening, just the creative ways that these banks figure out to just generate money out of thin air. But this is a serious problem because this infinite money glitch, as I'm calling it, is a way that this is how the banks are inflating the dollar. And this is a serious problem because if you look elsewhere in the markets, they are moving their money elsewhere. And I want to thank Randall Cornett in advance for this information. So just in the last 6 months, not even like 8 months, since January of 2022, this is the US dollar versus the Japanese yen, USD JPY. This is the Forex market, which is showing money moving into the Japanese yen. The higher this value is, the more valuable the Japanese yen is versus the dollar. And look at where this is going. Fucking March. This thing exploded in value out of nowhere. 18% increases on the Japanese yen versus US dollar. These fucking banks are moving all of their money into foreign assets. They're putting it all into foreign currencies and they're taking it overseas and they're pulling it out of the fucking reverse repurchase market. They're taking money from the Fed, inflating the dollar, generating cash, pushing it into the economy, and then when they feel like they've got enough of it, they shove it into another asset somewhere overseas where they can't fucking touch it anymore, and they hyperinflate the value here. And this is the market that they're going to go with. This isn't the only one. They're moving it into all kinds of assets. You can see this in the metals market. They've been moving it into gold starting in January. Gold exploded from what's this value from the XAU USD Forex market? It went from 1787 all the way up to a freaking peak of 2060. Yeah, 2060. It's a 50% increase. And it correlates with the US dollar and JPY increase. So at the same time, they took all of this fucking money and they pushed it into all of these other assets. The fucking banks are using the Fed as a liquidity engine. They are using the Fed to just generate them dollars out of thin air. And the Fed is either complicit or they're unaware. I doubt, however, that they are totally unaware of what's going on because this has a direct effect on the amount of money that they put back into the money market. And that is how they push money out to the other banks. So I know that the Fed has the power to shut this off. They can turn this off, but they are choosing not to for some reason. And this is what I want. I want to challenge Congress to look at this because this is a serious fucking problem. If the Fed doesn't get control of inflation, it's going to absolutely destroy our economy. It's going to hurt us all. We're going to be paying a different kind of tax that comes in the form of our buying power being next to nothing. We'll have to be wheelbarrowing our dollars up to the counter to go and buy bread. It's the exact same situation that we saw in post-World War I Germany. That's the kind of crisis that we are talking about if this happens. We're talking about going back to the days of 1970 when the interest rates were above 18%. This is something that our economy cannot sustain right now. And the Fed is backed up into a corner. And the banks, I feel, are taking advantage of it. If there is not something done to get control of this, if the greed of the banks is not put under control, and this abuse doesn't stop right now, it's going to crash the dollar. This is actively inflating the dollar as we speak, and it's going to continue. And something is going to come out of this. Something is going to happen very, very soon. I have a feeling that this is going to trigger a market crash even bigger than what we just saw recently. And the 2008 crash after this is going to look like fucking nothing. I want everybody to be very acutely aware that we're seeing signals coming from the market that there is obviously we're in a bear market right now, and there's all kinds of news articles that are trying to convince people that it's going to be fine, the market's going to be totally okay. And we even read this article that I can't believe this. It was this article by investing.com that insists that that the worst that things can get for the S&P 500 is 3,000, which I think is grossly underestimating just how serious our economic situation is and how bad it can possibly get. But there's articles like this coming out all over the place. God, I hate Google ads. But suffer through it with me for just a second. The situation that we're in economically speaking is putting us in a combination housing crash of 2008 with the inflation crisis of 1970s and the dot-com bubble when the Nasdaq collapsed. All of this is happening at the same exact time. This is going to be, without a doubt, the worst market crash that we have ever endured in the history of our nation. And it's going to affect the world economy. The banks are going to figure out a fucking way to profit from this, and I think they're actively doing it through reverse repurchase agreements because they can use it to generate cash, and as soon as they feel like they've got enough, they move it into an asset class and they move the market. And that's going to be a problem for us because the banks are going to use this as a vehicle to escape into international markets and retain their assets. But the rest of us left here behind in the United States are going to be holding the bag, and we're going to be stuck using dollars that are damn near worthless. This is something that needs to be looked at. Congress needs to get their asses on this and stop sleeping at the fucking wheel. This has gotten out of control, and this is going to continue. After this I'm fucking serious. After this crash plays out and we're back down below the lows from the COVID crash and we're still going down, then, only then, will they finally fucking look at what happened here after this crash occurs and it's too late. People are losing their homes and their jobs all over the place. I'm really fucking worried about where we're going. I I know that people are upset at me for being all doom and gloom and just shouting about Armageddon from the mountaintops, but this is a serious, serious situation, and people need to understand this. I'm gonna keep repeating this as many times as I have to. I'm never going to stop talking about this, and I'm begging y'all, please, please do your research. Please try and figure out how to save your money and how to protect yourselves. Figure out a way to move your assets into something with intrinsic value. Figure out some way to make sure that you're saving your cash, holding on to it, and putting it somewhere safe. And if you're able to, I it's a risky business, but if you can figure out a way to make something out of this market as it goes down, then it is in your interest to do so. It's in all of our interests to do so. Because the only way that we're going to end up on top after this happens is if we have a full understanding of the mechanics of this market as we go down. It is coming down, and it's not even a matter of when at this point anymore. We're in the middle of it. So I'm sorry that this turned into such a flaming rant, but I'm so concerned for everybody that's not just in my community, but elsewhere on social media, and especially for the ape community, and for just Americans in general, because it's average people that are going to be hurt by this all across the board, all over the United States, and even across the world. People that are in the lower half of the 50% income gap are the ones that are going to suffer the most for this, because we're going through a we're going through a combined inflation, housing crash, tech bubble, on top of wars happening across the world, massive prices of oil skyrocketing, the price of gasoline skyrocketing, and we're even going through food shortages now. And food has been rotting on the vine for months, and farmers aren't getting access to fertilizer. Like, there's so many things happening all at the same time that people aren't even aware is going on. And there's still people that are buying houses at hyperinflated values and throwing their money carelessly at the stock market. This isn't the time. It's just not. And all the while this whole system burns around our heads, we're just sitting at the table, just sipping our coffee and insisting that it's all fine. It just floors me. I'm sorry that this turned into such a rant video that went on for so long, but I want to thank you for taking the time to read through this with me. And I hope that I was able to explain it in the way that made sense, and that I was able to give you some information that you found useful. The situation right now is extremely dangerous, and I want to caution absolutely everyone who is willing to listen against being careless with your money right now. It's not a good time, and I really want to help protect as many people as possible by letting them know what to look out for, what triggers and what markers there are for a crash. And so far, thank God, Hell's trading floor has somehow been able to maintain its profitability, and I'm seeing more wins from the community than I have as we've been going through this crash than I have since we started. It's obvious to me, and it's obvious to the analysts and the mods, that we're collectively getting more intelligent and we are getting better at this. And I'm really, really grateful for everybody who is in the community that came together and made this possible. So the list is too long to name everybody, but thank you all for being a participant in Hell's Trading Floor. I'm so thankful for all the mods, the managers, the analysts, and every single one of you who has been a part of this. It's been a fucking revelation and a revolution of tremendous magnitude, and it's really changing a lot of people's lives. I hope that it will end up being for the better and that we come out on top of this thing no worse for the wear. Thank you guys so much for watching, and I will look forward to seeing you tomorrow at the bell, at which time we will have a hell of a time in the markets.